Welcome back. We just showed you U.S. markets in solidly positive territory. Let's talk about what could be ahead for U.S. markets with Keith Buchanan. He's Senior Portfolio Manager at Globalt Investments. Keith, thanks a lot for joining us. As we speak, with today's rally, the S&P 500 now solidly in positive territory for the year so far, up 2.5%. It's been a bit of a wild ride, but markets have certainly been much more positive than negative since the middle portion of April. What are markets pricing in right now as they look ahead 12 to 18 months?
Sure, and thanks again for having me. The markets over the last 2 months have really been pricing in iterations of improving prospects for international trade on behalf of the U.S. And first it was the U.K., of course, and now we have the U.S. having direct talks with China as we speak. And as each iteration has come to pass, the market has taken a positive cue from each development as we kind of moved along these negotiations since really the week after April 2nd. So 2 months or so of these continued positive developments. And the market's pricing in a more optimistic scenario with 22 times earnings or so for next year's earnings, which isn't quite as expensive as it was before April. And in January kind of had the highest valuation on a forward-looking basis. But we're approaching that level. And the optimism that was apparent in January, we're coming to grips with what it means for the market to be at the same valuation level looking forward, considering there are still risks that we just had no clue could come to pass back in January. So we're cautious about kind of where the market is approaching at these levels.
What do you think the market is pricing in with respect to the tariff issue? Is it pricing in a very substantial reduction in tariffs between the U.S. and China, between the U.S. and Europe, or is it pricing in a reduction to a baseline of, say, 15% tariffs on U.S. on foreign goods imported into the U.S. at large?
Sure, that's the million-dollar question right now. What is the market pricing in, and how is it pricing in such a scenario? The market is absolutely pricing in a lower tariff level than we currently have with nations that we are currently negotiating with or have deals that are starting to take shape. The optimism that's baked in is warranted because of the momentum that the U.S. has had as far as getting some of those resolutions kind of behind us in the rearview mirror. But stock markets are generally optimistic, and we, as the U.S. market has taken shape again up at this level, approaching the most recent highs, all-time highs, if you will. The concerns that we have is that the tariff level will end up being north of what the market is expecting, and what does that mean for that optimism on the valuation standpoint, also the denominator in the valuation of earnings? What impact does that have on earnings when we have a more concrete landscape as far as tariff policy around the world, and what that means for profitability with U.S. corporations? So all that comes into play and is really hitting the head on each iteration of these negotiations, whether it's feedback from social media or news that we're getting from those at the table. It's really swaying markets one way or another, and we've seen that largely positive over the most recent, again, 2 months. But the mechanism of forward-looking mechanism of markets indicates that there's an optimism that we haven't yet achieved in what we see on the ground as far as the tariff policy, and implying that there is a continued development in that regard. And we're still making sure that that's going to be the case if the markets are pricing that in at this point.
Your view on tariffs is not only do they send a broadly negative a signal about future economic growth, but very specifically, they will affect earnings at individual companies, correct?
We've seen that last earnings season, and it's pretty apparent that corporations look at have negotiated around tariffs and affecting not only the products on shelves, but also how they manage inventories. And we saw some of that impact, of course. GDP in the first quarter is really, it dictates a lot of what corporations do as far as the planning process and also how they implement those plans going throughout the year. And the impact that it has, the uncertainty is probably the most problematic. And as it becomes less uncertain, that obviously helps corporations plan, and that is in and of itself business and economic activity. But it makes for a landscape that's really uncertain if those negotiations are still ongoing and there's still a back and forth with the U.S. and its largest trading partners that leads to businesses not being able to make plans and take action in a timely basis as they would if they were achieving, be able to achieve maximum profitability. So that's concerning is the E and the expected growth of, north of 10% right now in 2025 and even, significantly historically high growth in 2026 as well. Is that achievable with tariff levels at this current level? And does that price in, a certainty and an optimism that corporations, when they report earnings, just couldn't communicate at that point? So we'll have to see a development in the next earnings season we'll get later in the summer of corporations just having more certainty, their arms bit around their guidance for the year, especially coming into the latter half of next year as well. So that's all kind of coming ahead right now. We see CPI coming this week, and that's going to have some implications of how those tariffs really hit the ground. And that'll give us a sense of kind of where prices are moving in the near term.
Yeah, that was my next question. We do get inflation numbers in the U.S. tomorrow morning at 8:30, so they're less than 24 hours away. The expectation of economists is for only modest upticks in May inflation, the annual pace of inflation in May versus the annual pace of inflation in April, 2.4% on a headline basis in May, up 10 basis points from April, and 2.9%. Excluding food and energy for core inflation in May versus 2.8% in April. If that's the way it plays out, if that's what is reported, do you think the market will become more comfortable with tariffs, inflation, and earnings?
If that's what's important, if that's what reported, we see that as growth on an overall aggregate basis, and that's something we haven't seen in several months, and that causes concern, and the reaction function, of course, is what everyone is worried about. Is how does the Fed respond? And the pickle they're in from their dual mandate is, if employment does continue to seemingly soften on the margin, and because of economic stress from tariffs and just slowing growth, even before we had tariffs really started taking its impact. And inflation remaining higher than they're comfortable with and even moving in the wrong direction. I think the nominal level of where we are currently is less of an impact, but the direction in which it's moving is not towards a 2% target, but actually kind of lingering around this level that's causing the Federal Reserve and any central bank a lot of concern. So, we're in the camp where we don't necessarily see the nominal level being a huge concern. We all know around 3% and kind of been there for a while. But moving higher in any level is concerning at this point, and puts the Federal Reserve in its ability to become less restrictive, more challenging. And that causes, of course, markets to react accordingly to that, that stance from the Federal Reserve. So that's a concern as well.